Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
Will higher interest rates slow housing sales? I'm sure all of you are curious about that at this point because we have higher interest rates. Several weeks ago, I reported to all of you that you might want to reach out to customers who are looking for homes to invite them to understand that the conditions changed a bit. And today I want to talk to you a little bit about, well, will it have an impact on not the current customers, but going forward, the housing market in general. The first quarter of 2018, we witnessed interest rates leave historical lows of around 4.25% on 30-year fixed-rate mortgages and move up to where they are today, around 4.75% to 5%, depending upon a customer's profile. In context, we're still talking about almost generational lows in the cost of money to finance a home. However, the question really is then again, how interest rates affect housing. And we want to help answer that for you a bit today. And I think it's going to help you feel better about the future going forward in the business. Typically, we have relative volatility in the marketplace, meaning the last couple of years we've had very low volatility, but we typically have more volatility. We've seen that so far this year. And so it feels like it's atypical, but it's really more typical. And 16, that is 2016 and 17, were just not typical, meaning they had less volatility. So in the first quarter of this year, what happened? Well, we got really good news. We had a tax change at the end of the year. Corporations pay lower taxes, probably pretty good for the employment market. In addition, we had information around employment, not only the numbers of people being employed, but for the first time in a number of years, we saw wage increases as well. That's a good thing. And so we experienced volatility in the market. People wondering what the Federal Reserve, in terms of long-term interest rates, what will they be doing going forward? All of that created stock market volatility, the best way for you to understand it. And so we had increases and decreases and back now to decreases as we're in March, a little bit about where we were to start the year, but it's been kind of an interesting ride to get there. We're going to get back to rates and housing in just a second. A reminder, and we're on an interesting graph right now that shows you interest rates really over the last 50 years in America. And so we had a high point back in the mid-80s where interest rates were around 18% on fixed rates. So today, in context, when you hear 4.75%, that's really high compared to 4 or 4.25%, or maybe last year 3.5%. But in comparison to the last 50 years, the average interest rate over the last 50 years on a 30-year fixed rate mortgage was around 6.5% to 7%. So at 4.75%, today's levels, we're really still at, as I suggested earlier, generational lows in terms of cost of money. And homeownership is then about as affordable, even though prices are going higher, as it's been in the last 50 years. So let's talk about what really drives housing. And I think you're going to like this news. That is, if we look at the next graph, we see a housing sale graph over a long period of time. And we show two pieces of the graph that I think are important. One is interest rates and the other is unemployment. And if you follow the trend lines in the graph, what's crystal clear is employment plays a much bigger role from a correlation standpoint in predicting the conditions of housing than does interest rates. So you see interest rates being somewhat volatile during the period. And generally speaking, when rates go down, that's because the economy's not so good. And so housing sales aren't necessarily getting better as rates are going lower. As many would think intuitively, the lower cost of interest rates would drive more housing. That's not necessarily the case. What does drive housing is the idea of a strong employment environment. And we have today the best employment environment that we've had in a generation. We're down at a generational low at 4% unemployment, 4.1%. And we're continuing to grow jobs at record paces right now. And as I already mentioned, we're seeing interest rates go higher a bit as a result and because of wage increases taking place. But more jobs getting generated, better wages, and we're continuing then to see more people get out of school, get jobs, more houses being formed. They're going to want to go out They have to either rent a home or they have to buy a home. And we're seeing many of those people get into the market because real estate has shown itself over a long period of time, with some exception, to be a very good investment. So we do have a very strong economy today, U.S. economy. The tax cut, we haven't even seen the benefit of that yet. We'll see that likely as 2018 continues. There obviously are some headwinds in real estate, not enough inventory. You're well familiar with that idea. But the bottom line is that will higher interest rates dampen the housing market? History tells us it won't. What history tells us is that as long as we continue to see a strong employment climate, we're going to see a strong housing environment, and that's what we have right now. So the good news is that cost of money being a little bit higher, the better news is unemployment continues to get better. We're going to continue to see a strong housing market. We look forward to doing business with you, and thanks for participating today in News You Can Use.